How does the stock market work? Hello, everyone, and welcome to another episode of Learning. Should you invest in the stock market? Nowadays, the idea of investing in the stock market has become popular among young professionals and millennials. To some who have limited knowledge and experience, the thought of investing scares them because of the risks. Two things: returns are not guaranteed, and you are most likely to lose money at some point, particularly during market volatility. That is why it is imperative that we understand the fundamental concepts of stocks and other securities, how they are traded, and how the stock market works in general. To understand how the stock market works, let's begin by delving into the definition of securities. Securities are negotiable, tradable financial instruments with monetary value, which can be issued by the government or commercial companies. Securities like stocks are tradable, meaning they can be sold and bought and can easily be exchanged for the same type. Example, you can buy common stocks and sell common stocks. The government and corporations are the issuers of securities. Government can borrow money by issuing securities such as treasury bills and treasury bonds to raise capital to fund for its projects and programs. In the case of companies, they generate a lot of money when they sell stocks to the general public. On the part of the investors, they buy securities such as stocks with the intention of holding them for investment. As you can see, here are some of the popular securities in the market. We have stocks, bonds, treasury bills, commercial papers, UITF, savings account, time deposit, mutual funds, derivative instruments. Stocks give investors ownership rights, preemptive voting rights, and claims from the earnings of the company through dividends. Bonds are entitled to receive interest. For derivatives, there is right to buy and sell or trade options. Mutual funds is an indirect way of investing in stocks wherein money from investors are pulled together and then the fund manager invests the money into different types of securities. UITF, savings account, time deposits, these are products offered exclusively by banks. In the Philippines, the trading of securities is regulated by no other than the Securities and Exchange Commission, or SEC. Aside from regulating securities in the market, SEC also ensures that the interest of the investing public is protected. The securities market provides investors the opportunity to buy shares of stocks of publicly listed companies in the stock market or to lend money to the government through bonds. For example, an investor invests in a company which will then be used for its expansion, long-term growth, and other company objectives. In return, investors receive profits or dividends from the earnings of the company, which can also help him achieve financial goals. So it's basically a win-win solution for both the supplier funds and the demander of funds. Now, how do companies raise capital? As I mentioned earlier, companies raise capital to finance its projects and other operational objectives. It can ask for additional capital contribution from its existing shareholders or partners. It can also reinvest its profits. Or, as the need for more capital arises, companies can opt to use debt financing or equity financing or a combination of both. In debt financing, companies borrow money from banks in the form of loans. And aside from borrowings, companies can also issue corporate bonds and commercial papers and then issue interest payments to their bondholders. The main difference between bank borrowings and bond issuance is that loans are directly borrowed from banks or financial institutions, whereas bonds pass through middlemen or brokerage companies. Another way for companies to raise capital is through equity financing by issuing preferred stocks or common stocks or both. This enables investors partial ownership interest in the company. Unlike debt financing, companies here are not obligated to pay interests, dividends, or pay back their investors. Most companies, they have shares, but only the shares of publicly listed companies are found on the stock exchange. All right, talking about stock exchange. It is the organization that facilitates the trading and exchange of stocks and other securities listed therein. As I mentioned earlier, companies can raise capital through equity financing, meaning it can solicit additional funding from prospective investors such as angel capitalists through a capital venture, crowdfunding, or from another company, or it can offer its shares of stocks to the public. They can do so through an IPO, or also known as initial public offering in the primary market, and by listing in the stock exchange, which is a secondary market. In the Philippines, okay, it's the Philippine Stock Exchange or PSE. So once the company shares are listed on a stock exchange and trading starts, the price of stocks are expected to rise and fall as demand and supply for the stocks fluctuate too. Through the stock exchange, existing shareholders can transact with potential buyers or investors. As the term secondary market means, when you buy shares of stocks from PSE, you are not buying shares directly from the company, but from its existing shareholders. Likewise, when you sell your shares, you are not selling them back to the company, but to other buyers of stocks. From an IPO and stock exchange listing, a private corporation is then transformed into a public corporation, or also known as publicly traded or publicly listed companies. A very good example of a successful IPO in the Philippines is that of Pure Gold in 2011. It sold 600 million shares at 12 pesos per share. In one day, did you know that Pure Gold was able to raise 7.2 billion? That enabled Pure Gold to restructure its debts and pursue its long-term expansion. No wonder why the number of Pure Gold outlets, from supermarkets to Pure Gold Extra and Junior, have suddenly surged since 2011. How does the buying and selling work? Well, many people are interested to invest in stocks like Pure Gold, Jollibee, SM, but clueless where to start. Unlike the manual application before, nowadays it is more convenient to open an investment account online. For instance, you have cash to invest in the stock market and your goal is to own shares of stocks of a company. All you have to do is open an account in a brokerage company. Well, if you go to any Jollibee branch, for instance, you cannot order and tell the crew, hey, let me buy Chicken Joy, burger plus 10 shares of Jollibee. You have to pass through a middleman, which is a brokerage firm or brokers. Brokerage companies have platforms that are directly linked to the Philippine Stock Exchange platform, which will enable you to trade, buy, and sell stocks using the web or mobile phone or in the comfort of your own home. Now, sellers of stocks who obviously own shares of stocks and plan to cash out or redeem their investments would also need to pass through a brokerage. Remember that the stock exchange provides an online platform matching the buying and selling transaction. So that when you buy stocks, you don't need to find a seller, or when you sell, you don't have to look for a buyer anymore. The system would automatically do that for you. And take note, you can be a buyer or seller of stocks using the same brokerage platform or brokerage company. For prospective investors, choosing whether to invest in common or preferred stocks can be quite confusing. Let us differentiate the two. Let's start first with preferred stocks. Preferred shareholders normally receive regular dividends, and in fact, they receive dividends first over common stockholders. They also take claims priority upon liquidation of the company or in case of bankruptcy. However, they do not have the right to vote or have a voice in managing the business. Common stockholders, on the other hand, are known to be the real owners of the business. They have voting rights, meaning they can elect members to the board of directors. They have preemptive rights and other rights not available to preferred shareholders. And although they are said to be residual owners who are last to receive dividends, their earnings are not just limited on the company's profit, but on capital gains as a result of stock price increase in the stock market. This is one of the reasons why common stocks remain to be attractive and why majority of stocks traded in the stock market are common stocks. All right, are you familiar with these companies? Would you like to own shares of stocks of these companies like Jollibee, SM, PLDT, Smart, GMA7, Universal Robina Corporation? While it is true that when you buy stocks, you own a small piece of that particular company, but the thing here is there are rewards that far outweighs the cost of investing in stocks. You also get to share in the profits of the company. You can technically own Jollibee through a franchise, but you'll be needing around 40 million and up to be able to buy one. Through stock investing, you can start with minimal amount, say less than 3,000 pesos, and own shares of Jollibee. Or you can start up your own business, but definitely that would require huge amount of capital to start with, not to mention the efforts that you have to put into it to keep it running, right? So stock investing gives you and the other investors opportunity to own shares of stocks of these companies without having to manage them 24/7. You simply let the management team in place, the likes of Zubeldi Ayala, Gokong Wei, C, and Tony Tan Kak Shong lay down their expertise in managing the company for you. Owning stocks in different companies can in fact help you build your savings, protect your money from the effect of inflation and taxes, and maximize the return from your investments. Historically, stocks have shown that over the long run, they have generated higher returns compared to other securities in the market like bonds, time deposits, and ordinary savings accounts, and even preferred stocks. The next time you visit a Jollibee branch, you can proudly say that, hey, I'm not just a consumer, but a part owner of Jollibee. Or the next time you shop at SM, you can say, I help these employees of SM earn a living because of my investments. Isn't that amazing to own part of a company that you love and patronize? Now let's take a look at the stock market. The overall stock market is made up of investors, traders, corporate investors who either buy or sell stocks or do both. This provides ordinary people with the opportunity to earn and help their money grow over time. Buying shares of stocks, also known as equity, enables investors to have proportionate share in the company, which is not commonly present in an employment setup, right? Wherein you have a boss and you rely on when you'll be given a salary increase. Now, while working as an employee or managing your own business, or even as a student or simply housekeeper, you have the opportunity now to earn more income. Typically, each share represents a single unit of ownership of the company. For instance, if the company has issued 1 million shares of common stocks, an individual that owns 100,000 shares would have a 10% ownership stake in it. As investors acquire more stock, their ownership stake in the company becomes greater. Generally, for every share of stock that you own, you are entitled to one vote. So if you own 51% or majority of the stocks, you can already secure your power and control as part of the board of directors. At this point, I am sure that you are curious as to how you can earn in the stock market. There are ways to earn from your stock investments through dividends and through capital gain, or also known as capital appreciation. Okay, let's start first with dividend. This is the share of profit that a company distributes to its shareholders. This is the share of investors in the profit or retained earnings. You can say that this is some sort of rewards of companies to their investors for putting their money into the company. Dividends are subject to the approval of the board of directors. There are companies that do not pay dividends, and it's either because they are not earning, or if they are, it is simply because their retained earnings is restricted and is intended for expansion, long-term growth, and other income-generating projects of the company. Dividends is a reflection of how efficient the company is in managing its company and its financial resources as reflected in its financial statements. So we can say that it is internal to the company. Capital gain, on the other hand, is the increase in the stock's market price, the price for which it is traded in the stock market. It is computed by getting the difference between the purchase price and the selling price of your investment. To understand it better, let us take Jollibee stock price for example. So just a disclaimer, I am not endorsing Jollibee, but merely using its data for illustration purposes. All right, so if your grandfather invested in Jollibee on its IPO date on July 14, 1993 at 9 pesos per share, worth 1 million pesos, he would have owned 111,111 shares. Okay, as of October 1, 2021, the current market price of Jollibee is already 202 pesos. To compute for the capital gain, we simply get the difference of the price from which it was originally bought, which is 9 pesos, from the current market price of 202 pesos. The result is 193 pesos per share. 193 pesos times 111,111 shares. Your Lolo now has 21 million pesos capital gain accumulated in 28 years. My question is, would you be a happy grandchild of your Lolo, knowing how millions richer your Lolo has become? That's another story. But this historical performance simply shows us that there is a great opportunity that awaits investors out there. Just don't forget that there should be a trade-off between returns and risk. While stocks have the potential to generate money for you, you can also lose money if you do not understand what you're going into. What is minimum board lot? It is the least quantity that can be purchased depending on market price of the stock and the minimum investment that an investor in stock must have. Let's take, for instance, the stock price of Jollibee as of October 1, 2021 is 202 pesos. So it falls under this bracket, 200 pesos to 499.80. So the minimum board lot is 10 shares, meaning to say you can buy 10 shares of Jollibee, but you cannot buy 7 shares or 2 shares or 4 shares. It has to be 10 shares at the very least. Okay? And it should be multiple, meaning to say you can buy 10 shares, 100 shares, 20 shares, so that's multiple of 10. A buyer of the stock must order at least 10 shares amounting to 2020. So that's 202 pesos times 10 shares. You need to have at least 2020 to be able to buy Jollibee shares. But of course, you have to add additional amount for processing fee, brokerage fees, and commissions. So it would be, I think, safe to say that with the minimum of 3,000 pesos, you can already start with your Jollibee initial investment. What affects stock prices? As we all know, for every buyer, there is a seller. If there are more buyers of stocks, the price of that particular stock will go up. Did you know why the price of iPhone continues to go up? Well, aside from the quality, there is also a demand for it. People are willing to buy iPhone despite its price. Conversely, if there are more sellers than buyers, the price will eventually go down. Okay, let's not go far. In a typical supermarket, having numerous sellers or competitors offering the same product would trigger the price to go down. If, for instance, Aling Anna would sell a cone of ice cream for 50 pesos, Aling Nene would sell hers for 45 pesos. Knowing this, you would expect another seller, another competitor, Aling Maria, telling her customer, Suki, my ice cream is 40 pesos only. See, more sellers tend to pull prices down. That is the law of supply and demand. And it holds true even when it comes to stock investing. Now, there are various reasons why there are more buyers or demanders for stocks, as we can see here on the table. Okay, when investors have savings or extra money, when the company has strong earnings, there are new mergers and acquisitions and future projects, new products, services, or improved technology, when there is economic growth, positive environmental changes, positive speculation, there is political stability and confidence in leadership, and when there are good news or issues about the company. Why are there more sellers? When investors need cash, definitely they would redeem and cash out. When the company has weak earnings, stagnant growth or no expansion or future projects, there are no new products or services, obsolete technology, when there is economic recession, environmental problems, negative speculation, political instability, or any bad news or issues about the company, that would trigger the prices to go down. Investors are often faced with a decision when to buy and sell their stocks. If investors are optimistic that the stock value of their company is going to rise, they'll buy more stocks so as to earn more money in the stock market. If investors anticipate that stock value of the company is going to decline, they'll sell their stocks so as to avoid losing more money in the stock market. This is also the reason why a lot of investors lose money during economic recession or stock market crash. Investors panic, and so they sell their shares of stocks even at a loss to avoid losing more money. The thing is, it is normal for prices to go up and down. But you have to remember that price of strong companies of quality stocks would eventually recover. In fact, one of the strategies in investing should be buy low, sell high. Buy shares when the stock prices are low, sell shares when the stock prices are high. Buy shares when the prices are low because you're basically buying them at a discount, provided that company you're buying is really strong and stable one. It is useless to buy weak companies with cheaper price, right? Time, not timing, is what matters because you cannot really time the market. You'll never know if tomorrow the prices will go up or down. What's important is the time you have in the market. Time can be your ally in building your wealth. Okay, second to the last slides. After learning fundamental concepts about stocks, its pros and cons, and how the stock market works in general, you might ask, what more can it offer to me? Okay, I'll go back to my first question. Should you invest in the stock market? Well, yes, it can offer you several benefits like the potential to earn dividends and capital gain, help you diversify your portfolio, enable you to offset the effect of inflation or taxes on your money, and when done right, you can grow your money in due time and indeed help you in achieving your financial goals in life and ultimately attain financial security. But did you know that aside from helping yourself, investing in stocks is also a good way to support our local companies in the Philippines? What better way it is than to support companies whose mission you support and believe in? Companies that raise capital through share issuances use the money of investors to expand further. When companies grow and branch out, they'll be needing more people to work for them. In a way, you are also supporting the employment rate to rise. When people are employed and are improving their standard of living, they can offer food on the table, send their kids to school, and simply provide a better life for their family. People will have more purchasing power to consume, and consumption, as we all know, contributes to our economy. When businesses grow, suppliers and small businesses also grow. Our micro, small, medium enterprises, and even corporations are considered the backbone of our economy. When the stock market is doing well, you can expect that the economy will also do well. Suffice to say, the stock market and the economy are in tandem. When the economy is doing well, better services are provided, there will be more infrastructures, better health services, and other programs. So when you invest in the stock market, you are contributing to the success and growth of the companies you are investing in and the economy as a whole. Before you throw in the towel and invest in the stock market, make sure to set your financial goals first, as it should match the type of securities you're going to choose. Having goals can definitely motivate you to continue with your investment journey. Next, assess your risk appetite and determine how much loss you can take. Will you be okay with a 10% loss? What about 50%? Next, how long would you be parking your money in stocks? If you will be needing the money in less than a year, then the stock market may not be a good option for you. Stock investing works best for long-term investors as they can wait for years for stock price to go up. Other things that you need to remember: diversify your investment. Do not put all your money in just one type of investment to avoid losing more money. Invest early. The earlier you start, the better. Invest long term. Give your money ample time to grow as you take advantage of the compounding effect of your money. Invest consistently. Discipline is key. You can make big money even from small amounts for as long as you do it regularly and consistently. And finally, invest in education. Warren Buffett, one of the world's richest men, said, "The more you learn, the more you'll earn." The reality is, investing in the stock market is rewarding, but not without risk. But being well informed combined with discipline can be one of the most efficient ways for you to build up your wealth. If you have learned something valuable from my presentation, would you care giving me a thumbs up, like, and subscribe?